I don't have a presentation.
Oh, that's even better.
Okay, good morning and warm welcome to all of you. I don't have a presentation pre-prepared, that is. So what I'm going to do is focus on history and all of that, sectors, stocks, etc. I would like to focus more on what I see as evolving factors globally and how they will impact us in the next 3 to 5 years. And this is certainly crystal ball gazing. So more than providing any definitive answers, which is certainly going to be a very difficult task, I would sort of focus more on asking questions and leaving them with you so that you can then, as time progresses, mull upon these and see how they impact asset allocation, portfolio constitution, etc., etc. Prem sent an email yesterday about the survey that had been done, and that showed that I think an overwhelming number of you, about 84% if I recall correctly, had said that you're bullish on equities over a 5-year period, and I broadly agree with that. Now, when you look at, just for the sake of reference, historical perspective on equity returns, in the last 20, 25 years or so, our equities, Indian equities, have returned something like 15% compounded annually, which also happens to mirror the growth in corporate earnings during that time period. And my belief is that it will be pretty much the same in the next 20 years or so. We've also seen that the markets tend to move broadly in a range of between 10p and about 20p, give or take a few numbers on either side in terms of an overshoot. And clearly, anybody who's been watching this over long periods of time has figured out that as you buy at the lower end of the band, you do a much better job in terms of your CAGR returns than if you buy at the higher end of the band. So that sort of is also something which I think will hold true as we progress. And today we are at about little less than 14p. So we are trading at below the median, which is about 15.5 times, closer to the lower end of the band, which means that the expected returns, therefore, from Indian equities going by past history ought to be interesting and attractive if you take a 3 to 5 year perspective, as is the subject matter of today's discussion. But let me turn to the more important point that I wish to discuss today, which is that we are in a rather unprecedented market environment. We've had a crisis in 2008, the likes of which the world has not seen. Maybe you have to go back to the Great Depression and the aftermath. We've seen responses by central banks, policymakers, governments, and especially this quantitative easing is again on a scale that has not been seen before. So we are really in uncharted territory. And to me, the biggest question that we need to ask ourselves as investors or advisors to customers is, what is more likely in the next 3 to 5 years? Is it going to be higher inflation or is it going to be deflation? And accordingly then reorient one's portfolio, one's asset allocation to sort of meet either inflation or deflation depending on which one turns up. Now my own, and as you all know, deflation is something where you have a constant decline in prices, and simply the fact that prices are declining makes customers postpone purchases, and that in turn has a very negative impact on the overall economic growth momentum of an economy. This is something that was last seen with great ferocity during the time of the Great Depression, and more recently in some form, in a similar, in some fashion in the Japanese economy since the stock market bubble burst in the early 90s or so. So certainly policymakers around the world are trying their best to ensure that you don't see deflation. At the same time, they do not want to see rampant inflation. There have been many episodes in financial history where you've had inflation gallop rapidly, and that then erodes the savings of many people and again creates a lot of economic issues. My own feeling is, and again, this is just my view, that one should be prepared for a higher level of inflation than what one has seen in the last 10 years or so. And what could be the possible reasons? Well, first of all, you've got a reasonably large measure of QE in the last 3 years. In fact, the most recent version of QE happens to be open-ended in some senses. So therefore, you've had a flood of money into the financial system at very low rates of interest, near zero, and that in turn has the propensity to lead to some misallocation of capital, bubbles being created in different parts of the global economy, which in turn could have, an impact on inflation. The second is that you've had an issue with austerity measures in many economies. And as you can see, in Europe, for example, populations are saying, well, create more jobs, increase wages. So I think there will be a clamor for higher wages as we go along, and that in turn will put price pressures on many industries, and one should be cognizant of that. The third is, as a natural consequence of QE, you have, again, bubbles created often in commodity markets. Again, these are much smaller markets compared to equity and bond markets. So oftentimes, a massive flow of money, can create a bubble, and that in turn actually creates issues for producers and consumers alike. So, in a nutshell, if you look at the impact of QE, recent policy responses, my own view is, we are going to see higher inflation than normal as we progress into the next 3 to 5 years. The other issue that one needs to consider is that as each economy tries to grapple with the challenges that have been posed in front of it, in the aftermath of the 2008 crisis, and as we speak, on an ongoing basis, is there going to be a greater focus on protectionism, which means, the whole issue of globalization that we've been used to in the last 20, 30 years or so, is that really sort of plateauing now? And will more and more economies take recourse to punitive tariffs to protect their markets, to protect jobs, etc.? Because once you do that, you automatically start raising domestic prices, landed prices. And then, of course, you have the issue of currency depreciation that also contributes to imported inflation. So if you really factor all these in together, at least in my opinion, one should be preparing for a higher inflation than normal. And I just am saying this to reiterate my point. Now, like cholesterol, you can have good cholesterol and you can have bad cholesterol. So good inflation is inflation that is accompanied by strong growth, strong demand. And that's when I think consumers can absorb that inflation simply because there is reasonable growth in the economy, jobs are reasonably plentiful, wage growth is seen to be acceptable, and that in turn propels demand. And sometimes in certain sectors, when the demand exceeds immediate supply, you have inflation. But that inflation is something I would not be worried about, because that is what I call good inflation, akin to good cholesterol. Bad inflation is when you have prices rising, but there is economic stagnation, and what in the textbooks they call stagflation. And that is not a good thing, because incomes do not rise, jobs are not plentiful, and yet prices are rising. And that in turn, lowers living standards and is obviously not a pretty situation to be in. I think insofar as India is concerned, if I were to look out over the next 5 years, I would argue that we will experience inflation, higher inflation than normal, but of the good kind in my opinion. Now, why do I say that? So I have a few points to support that argument. One is that we have a large population, and most of the investors that one meets are always intrigued and optimistic about the consumer demand in this country. And they know very well that a large part of our growth is driven by domestic consumption demand and not so much by exports. I think that has now become a standard slide in all presentations one makes to investors, whether locally or internationally. I think that is set to continue. In the context of that, once you have a large market that one needs to be a part of, you will continue to see a significantly increased trajectory as far as FDI is concerned. I saw some of the FDI numbers of the last 2 or 3 years, and notwithstanding market volatility, those numbers continue to remain very encouraging, and I think that will continue to be the case. So once you have more and more FDI, you continue to manufacture more locally, you create more jobs, more incomes. At the same time, because of the increased supply, you will probably keep a lid on price appreciation for those commodities or products or services that one is offering. The second is that technological advancements are an equally important factor in figuring out where prices stand. Now, I was at a conference recently where a gentleman from Silicon Valley spoke, and this was a conference in Hong Kong, and where he said, you think certain things are in short supply? Well, there are lots of advancements in technology happening which will come to the fore in the next 5 or 10 years, which will greatly reduce the prices, whether it be of healthcare or water, et cetera, et cetera. Now, you might say, look, if it happens for everybody. So, where is the question of inflation here? The answer, again, and this is just my opinion, is that we have the position of adopting some of the latest advancements in technology without having to go through various intermediate stages. And if you speak to anybody who has followed the telecom sector, it's not like we had a massive investment in landline telephony before we moved into wireless telephony. We sidestepped or we leapfrogged that stage and we adopted wireless telephony. And we have reaped the benefits of, massive number of users using mobile phones and where costs have come down. Now, in economies where they've gone through those intermediate stages, obviously a lot of capital has been put to work, so the adoption tends to be a little slower than in economies where you've not gone through the intermediate stages, where that not much of capital has been put to work, so you're much more eager and swifter in adopting those technological changes. So I believe, just as in telecom, you're going to see similar such technologies as and when they come up, if they are, obviously of interest and benefit to large numbers of people, that we as a country will benefit enormously from it. And that in turn will push down price points relevant to those products or services. And the last point that I want to make here is something which I've been saying now for almost 8 or 9 years. And this is a more overarching point, and which is gold. I'm bullish on gold. I think at some point the world will look at least the central banks around the world will look at considering the gold standard one more time. Whether it happens in 5 years or 20, I don't know. But as far as India is concerned, we're all well aware of the fact that we've been large importers of gold over the last 20 years or so. In fact, in some years, we've imported as much as 1/4 of the annual production of gold. The rough estimates suggest that we have anywhere from $500 billion to $800 billion worth of gold today in the household sector. Much of this gold is unleveraged. A part of it may be used to take loans, but the large body of gold in the household sector is unleveraged, is not mark to market. And therefore, there will come a time when, as gold prices continue to rise, which is what I expect will be the case in the next 3-5 years, or at least in the more immediate term in the next year or two, that a portion of that gold, let's say gold prices appreciate to the point where the household holdings are estimated at, say, $1 trillion, which is 1,000 billion hypothetically. And if 10% of the holders decide that, hey, prices have gone up high enough, let's take some profit. $100 billion of gold is converted into money, and that money is put to work in the real economy. Our economy's GDP today is approximately $2 trillion. So at today's GDP data, and that's like a 5% stimulus to GDP. And this at a time when there is generally an economic slowdown elsewhere in the world. So I think this in turn could also contribute to, continuing to sustain our growth. And if you therefore continue to grow at 6 or 7 or 8%, partly as a result of consumption demand holding up, partly as a result of this kind of stimuluses, if and when it should happen, through monetization of gold. That in turn attracts more FDI saying, hey, this is an economy that continues to chug along quite nicely. So you have more job creation, more demand, and then the virtuous cycle takes effect. So these are a few things which I think will pretty much be factors very important in determining our economic growth trajectory going forward. And the outlook, in my opinion, notwithstanding what we see and hear right now, whether globally or locally, the outlook, in my opinion, is very optimistic as I look out over the next 5 years. And like I said at the beginning, I think, if a 15% compounded annual rate of growth in equities over the last 20, 25 years can be achieved in the next 5, 10, 15, 20 years, if you as an investor or as an intermediary feel that is an attractive rate of return, I think we pretty much have a reasonable basis to allocate a lot more money to equities than fixed income in portfolios over that time period. The last point I want to make, again, is a simple point I make at all meetings with intermediaries and investors, which is please be realistic about the assessment of return, because oftentimes I notice that people look at the most recent rate of return they've made on their portfolios and then tend to extrapolate that over the medium to long term, which obviously is not the right thing to do. So as I said, if a 15 or 18% CAGR return from equities is considered attractive, I think that is very much within the realm of possibility over the next 5 years. And more importantly, you and your investors or your customers should also always pose the question of what risk am I taking to achieve this return? I think we ask that question less and focus more on the return probabilities, and that often tends to be a mistake. So once those two questions, what's my return expectation, what risk do I take to achieve that return expectation, are answered and are seen to be realistic, I think portfolio construction, asset allocation becomes that much more easier. So to conclude, I'm very bullish on equities over the next 3 to 5 years. Prepare for slightly higher inflation. Equities are always a great asset class to own in inflationary times, provided you pick the right sectors and stocks. But in general, they have been known to do well in inflationary times. And so, your conclusion in the poll is very much apt. Thank you again for your patient listening.
Good morning, friends, and thank you for being here and giving me an opportunity to share some thoughts on investing. Prem suggested that I should speak on equities and also some thoughts on what are the possibilities for other investments. Let me just start off very briefly with the economy, and this gives you the decadal growth rates of India. So how has the Indian economy behaved over last 60 years? And if you see that for last 40 years, every 10 years, the growth rates in India have been increasing. And I take great comfort from this, because this period of last 30, 40 years it includes almost anything that could have gone wrong with the country has gone wrong with India in this last 30, 40 years at some point or the other. And to my mind, the current decade, we should actually grow faster than even the last decade, despite some slowdown that is being witnessed right now. And let me share with you some thoughts as to what is driving this growth and why, despite the current sort of uncertainties or pessimism around, we continue to look for higher growth in the current decade. See, what is driving growth in India? As Nagnath said, that consumption is central to India, and I think this slide will simply tell you that what has happened to mobile telephony. Mobiles were just about 0.5% of Indians had mobiles in 2001, and with rising affordability, as mobile prices, airtime prices came down and incomes kept on going up, mobiles have become very, very affordable. So less people had mobiles in 2001 than compared to motorcycles, but today almost there is 70% penetration of mobiles, and motorcycles are way behind at just about 35% households. So as affordability keeps on increasing, what has happened to mobiles will happen over time to motorcycles and to cars. And that is what makes us very optimistic about the continued growth prospects in this economy. If you look at today, where do we stand with respect to cars? car penetration in India in terms of number of households is just about 4%. So we have a long, long way to grow, because before almost everyone owns a car. And I think that is the time when the growth potential of the economy will start slowing down. So that is one very simple thought. I think by 2020, India could be, or should be rather, one of the world's top 5 economies. If we continue to grow at historical growth rates, we should be a 5 trillion economy in the next 8-10 years, and which will make us the 5th or 6th largest economy in the world. And I think that is very interesting, because it will be hard for investors globally to ignore an economy which is among the top 5-6 economies in the world. And I also think that somewhere in the current decade, some people say it is already happening last few months, I think India will start growing faster than China, because the investment cycle in China is moderating, it is slowing down. They have made all the investments, but in India we need to make large investments. So it is likely that India may be the fastest growing economy in the world amongst the major economies, and it is the 5th largest economy. And I think that would be very powerful combination to investors all across the world. India has one of the best demographics in the world, and this again, I mean, if you look at the demographics of India versus China, China is beginning to age, and the age distribution clearly suggests that. On the other hand, the dependency ratio in India continues to fall. The dependency ratio is simply the number of people who are not working, who are dependents, to the number of people who are working. Some slowdown. I think the savings rate should continue to increase as dependency ratio continues to fall. And higher savings means higher investments are possible. And some of these things are what make us more optimistic about faster growth in the current decade than what we have seen in the last decade. I think let me just speak about equities very briefly. Indian equities, I have strongly believed and continue to believe they are a great compounding machine. And I am sure most of you would have seen this slide. And yes, I fully agree to what Anup said, that Sensex has the frequent changes in any index make it, less, less useful. But nevertheless, I think the returns from the index can be very easily replicated. So it is possible for you, me, or anyone to just buy the index. And if someone says index has delivered X% return, I think those index returns could have been achieved in the past, and notwithstanding continuing changes, we should be able to achieve index returns. Therefore, I think there is some relevance to the history of indices despite the frequent changes that we have witnessed. If you very simply see, the Sensex has not a very long history from 1979 onwards. Your 100 rupees then has become 18,000 odd today. So it's become 180 times. And what has simply happened is that you have compounded, the Sensex has compounded at 15, 17, 18% a year. And that roughly ties up very nicely with the nominal GDP growth rates of the economy. Till 80s, the real growth was low, inflation was high. Last 10, 15 years, we have seen real growths have gone up. Inflation has been lower than what we used to experience earlier. But net, the Sensex has been broadly delivering returns in line with the nominal GDP growth rates. And I think that's a fairly, to my mind, commonsensical assumption that as long as the economy continues to grow and as long as equities are not overvalued, Sensex should deliver returns in line with nominal growth rates. And as I mentioned to you, that's why I started with the economy, that we are optimistic on the real growth rates going forward. And therefore, we think Sensex should continue to do reasonably well. I think let me share with you one thought which I think is very important, why 9 out of 10 investors are unsatisfied with their equity portfolios. And I think the key is we are investing at wrong points of time. And investors are looking at equity the wrong way. In 2003, P's were 10 times, index was 3,000. After 10 long years, index was still 3,000. In 1992, it was 4,000. So index had not done well at all. P's were just 10 times. In that year, investors all put together invested just about 118 crores in 1 year. That's just 100 crores. And way back in 1992, one scheme had collected 4,000 crores, master gain. So when index is very cheap, we invest minuscule amounts of money. As the index kept on going up from 3,000 to 5,000, 6,500, 11,000, 13,000, 15, 16,000 for next 5-6 years. And as P's kept on going up from 10 times to all the way to 20 times, you found that the inflows which were just about 100 crores went up to 50,000 crores. Sorry. Yeah. So at 10 P's, at 3,000 index, we invested 100 crores. At 15,000 index, at 20 P, we invest 50,000 crores. Now, how are we going to make money on this kind of an investment behavior? And this has not happened in the past. If you go back in history, even early 80s, late 80s, early 90s, after a 10 times movement in the index from 400 to 4,000 between 1988 to 1992, Master Gain collected 4,000 crores. Way back in 1992, that was a very, very large sum of money. And it is happening again. I mean, now P's have come down again because index has not performed for last 4 or 5 years. And what are investors doing collectively? Last year in FY11, we withdrew 12,000 crores, and in FY12, we invested just about 500 crores. Now, if this keeps on happening, index may perform, funds may perform, some may not perform, but there is no way that investors are going to derive what is rightfully their returns. So I think the key issue is that most of us, in our endeavors to time the markets, we are simply extrapolating the past returns into the future. I think this is wrong, and this is what one should not do. And this is what I find very topical here. Einstein said that doing the same thing over and over again and expecting different results is defined as insanity. So it's a little rude, but the message I want to deliver home is very simply this, that if we keep on investing like this, then history will keep on repeating, and you cannot expect very good results from equity investments. The simple message here is that to invest wisely, to invest sensibly, focus on the PE multiples, don't focus on the news. When will you get low PEs? Low PEs will be available only when the news flow is bad, only when the environment is challenging. You will never get low PEs and great environment together. On the other hand, when P's are very expensive, it means that the news flow is very good. Everything is fine. As Anup said, he gave you that formula of a bull market. So if everything is green, then P's are already very high. I think, to my mind, if you invest at low P's and wait for 2, 3, 4 years, you will make more returns than what you normally expect. And if you invest at high P's, I think you may make a lot of money in 1, 2 months, but over 2, 3, 4 years, you are likely to be disappointed with your returns. I will not go into the details because time is short, but investments made in very bad times have given very good returns. For example, in September 01, if you invested, there was panic. In June 04, when BJP lost the government elections, or in 2008 panic. If you have invested at low P's, your returns 3 years, 5 years later have been very good. If you invested at high P's, let's say in Jan 2000, when everything was good, or in just before the Lehman crisis, when P's were high, your subsequent returns have been quite poor. So I think, just to my mind, don't read the front page of the newspaper when you are reading, or read it after investing. Go to the P multiple page first. If P's are low, think 2, 3 years, in parts, in bits and pieces, keep on investing. And when P's are very high, be at least cautious. So that was a brief overview on equity investing. Let me share some thoughts on alternate investments. I am not an expert on that, but anyway, let me share some thoughts. This simply gives you the returns of different asset categories, G-Secs in India. And what we have done for G-Secs is, we have taken 10-year G-Secs from 1982 till 1992, and then we have bought a 20-year G-Sec and held it for maturity. So it does give you some sense of what returns have come. Then we have given you the returns, prices of gold, returns of gold in rupee terms, Sensex in rupee terms, and the respective indices are in their local currency terms. What is very clear is that Indian equities have done quite well, and no doubt gold has also done very well, and I am not an expert on gold. Nagnath has shared some thoughts on gold, so gold I don't want to take any view on. It's beyond my capacity, in my opinion. But Sensex clearly has done quite well over 10, 20, 30 years. It has given one of the higher returns. And if you look at Indian bonds, when you are looking beyond Indian equities, Indian bonds have delivered returns comparable to what equities have done globally. So whichever markets you look at. And that is simply because other economies are growing a lot slower. Now let me caution you that a critic would argue that what about local currency terms? So, I mean, if you look at Dow, how has the currency behaved? These are not in the same currency. So, yes, that point is valid, that Indian bonds will deliver you returns as long or comparable to other equity markets only as long as the currency does not depreciate meaningfully. Last 10 years, currency has been reasonably stable, and therefore Indian bonds have been a good alternate to equities globally. This may or may not continue to happen in the future. But again, I will share with you some thoughts there. See, if you look at what is the problem with current account, why is the currency depreciating? If you look at the net gold imports for last 12 years, they have gone up from 0.3% to 2.2%. And that is half the problem on current account deficit. The second issue is that oil prices, which were $27, have gone up to $100. And therefore, oil imports have gone up from 3% to 5% of GDP. So these two imports, which were just about 3%, have gone up to almost 8%. I think these are the single biggest variables how currency will behave. If gold prices if gold import volumes don't go up, last 6 months gold imports have been coming down sharply. If oil prices remain stable or they come back, I think India's BOP can be very comfortable, and the entire deterioration is a result of higher gold imports and higher oil imports. Price in the case of oil and volumes in the case of gold are very important variables. I don't think anyone will have a clear answer on this, but to my mind one thing is clear: if oil prices don't go up, remain flat for next 2, 3, 4 years, or if they come down, then our current account will steadily continue to improve and currency may actually be quite stable. As I said, I am not an expert on gold, but I just want to leave a thought here that gold is not supposed to create wealth, but it has created a lot of wealth over the last 10 years. And today gold prices in real terms, in dollar terms, are close to all-time high levels. So, I mean, if I have to say something, all I would say is that probably the best of gold is behind us, but I don't want to take a position whether gold will perform or not perform. To summarize, I think Indian economy is a secular growth economy. It has its ups and downs once in a while, like we have had some challenges in last 1-2 years. But historically, we have always taken the difficult steps only under crisis situations. So change is forced onto us when we run into a crisis, and I think that is what we are doing today. So I remain optimistic that current decade we should grow faster than the last decade. We should be the 5th largest economy. We should be one of the faster growing economies. Currently, PEs are below average, and Indian bonds have also done reasonably well. So, I mean, let us not ignore the high coupons that Indian bonds offer, particularly if you have an environment of stable or low oil prices. I think oil is a key risk for India. I mean, our government will do what needs to be done over time, but oil is something on which we don't have a control. Lower oil prices will bring a lot of good news and cheer to India, and a sharp spike in oil prices will prove to be painful. So that's it. Thank you.
Thanks, Prashant. I think we've got a lot of interesting points. We're also going to move seamlessly into the next session shortly. So I'll ask maybe a couple of questions and then we'll take a few questions and then move forward. Let me begin with you, Nagar. I think if I got the sense right, you've given the strategic, and I think Prashant's given the tactical. Between the two, where are people going to put their bets, or where should people be betting on if you're looking at the next 3 to 5 years? I think you've painted the landscape pretty well, but I think what people would want to know is how do you direct your investments?
Well, all I was trying to say was that if inflation is indeed going to ratchet up in the next few years, then obviously equities are a good asset class to be in, and I think enough numbers have been put forward by both Anup and Prashant to substantiate that. And then, beyond that, it is up to the investor and the advisor to figure out risk appetite, which is why I made that comment at the end. It's not enough to say that even if you're a conservative investor, put everything in equity. That depends again between the investor and the advisor. But equities as an asset class, I think, will hold out very well in inflationary times. And I think we in India, again, I made the distinction, will benefit from what I see as good inflation, which is inflation that is also backed by strong growth, which is that much more beneficial, therefore, for equities.
So if I were to look at investor behavior, the sense I'm getting is that people are still wary from the lessons they've learned of 2003 to 2007, exactly the statistics that Anup presented. So what's going to change their mind? I mean, what can compel them to change their mind, apart from the facts that you've just presented to us?
Again, I'll refer to what Prashant presented, this mistiming that you referred to. Because again, we've been meeting investors over many, many years now. And there are two kinds of investors. One, if the market has been really good in the last year or two, the tendency to extrapolate that for a long period of time. And that's where you make a mistake because, you then take more risk without consciously recognizing so. The other kind of investor is the one who always harks back to a time when he lost money, and that is forever in his mind and does not wish to remove that mental block and go ahead. So I remember in the mid-90s or even in the early part of this, just before the bull market began, when we made the same pitch to investors saying, look, P's are low, growth prospects are good, they will only look back at the 2000, 2001, 2002 period and say, well, we lost money. And then they all came, to invest quite significantly, 2006, 7, etc. So I think, again, we have enough historical trends now to say, well, don't do this and don't do this and do this and do this. And that's, again, for the investment advisor community. You have the body of knowledge. You've got historical trends in front of you to tell your customers that if you're, one of either too optimistic or too pessimistic, please tread the middle path.
Prashant, I think the other question is, how do you define this current period? In the way the markets have maybe moved up in the last few months, but assuming even if we had not seen this movement, in the charts that you said, right? You talked about timing and mistiming. Where does this period fit?
Clearly, it's a low P environment, and that's why we have been actually positive on the markets for more than a year now. And I mean, we never say that markets will go up in next 3 months or 1 year, but all we are saying is that if you invest in low PE markets, over time you will make more than earnings growth kind of returns. And I think currently we are getting low PEs when interest rates are also close to a peak. I think that everyone would agree that 1 year from today, we don't know how much or when exactly, but interest rates will come down. And lower interest rates are very good for higher PE multiples. So all I am saying is if you invest today, remain invested for 3 years, 5 years, you should make more than earnings growth kind of returns. That's it.
So Anup, you've used the earning growth model very carefully, and you argue that earnings growth is really what drives valuations eventually and on the longer term. Again, what's the kind of earning growth that you're seeing today? I guess everyone knows it, but if you could put it in the context of where the markets are and whether this is a good time to invest.
I'll answer it differently. I worked in Chennai for 14, 15 years at the start of when we started the mutual funds. And one of the first concerns people would have is that why should I invest in equity markets because they are rigged and there are very few players and these numbers aren't correct. And I think so. One of the things that mutual funds haven't done enough is to convince people that if you look at our numbers from 1991 or 1993, and if you see the growth in terms of market cap, it has always, there happened along with growth in profit. So yes, you can have the odd stock which can be manipulated for 6 months, 1 year, 1.5 years. We all know of EduComs and others. But in the end, if you invest for a long period of time, and if you choose those fund managers who are slightly more sensible and they stay away from such bubbles, the growth in the market over the last 20 years has been followed, or that growth has followed the growth in profits. And I think so this market is not rigged, and people who feel feared about,
I agree with you conceptually. Yeah. I think the question is that at this point of time, are you seeing the profit growth?
I would say that I do treat equity as a different form of a 10-year GSEC. So in a government bond, you have an interest rate of 8% or 8.5%, 9%, and over a period of 10 years, you will get that coupon as such. And at times when you have some better, economic fundamentals, some of those returns either get, those come fast forward or those get actually back-ended. But you'll only make that 8.5% per year for the 10-year period of time. Similarly, if you take that India's earnings growth rate has been between 14 to 16% for the last 20 years, you will have 2, 3, 4 years, maybe at worst, when your earnings growth rate comes below that. And then you'll have 3, 4, 5 years when your earnings growth rate will be more than that. So maybe we could be getting into a period for the next 15, 18 months when our earnings could be lower than this average. But over a 20-year period, over a 15-year period, I don't see we have any such signal that our earnings growth rate over the last 20 years can't be then achieved in the next 20 years. But it will not be uniform. You can't say that each year will be growing at 14, 16%. So
I'm going to quiz you a little more, one more question on that. But Prashant, let me get your point on this. So I think everyone is trying to understand whether there is underlying strength, right, in the companies that you invest in their ability to perform or outperform in this environment. What's your call on that?
See, I think earnings have been, by and large, this is my sense on it, that earnings have been above analyst estimates. And analysts are also human beings like you and me, and when they read the news flow, they also make more conservative assumptions. So I think the earnings downgrade cycle is over, and now they are beginning to say that publicly. And whatever earnings we are seeing is in very high interest rate environment. If 1 year from today interest rates are lower, it will only help your earnings growth. So I think, as Anup said, you may not be able to forecast exactly next year what happened, but I think over the next 2-3 years, earnings growth should be faster to my mind than what we have seen in the last 2-3 years.
Nagnath, do you concur with that?
I agree with that. I think, if rates moderate and, you see a couple of years where earnings growth is 25% and not 10 or 15%, we often see that P's also gallop quite nicely at that point. So your compounding of, the confluence of higher earnings growth with a higher P is what then creates outsized returns in those time periods.
So the universe of companies that you invest in, to what extent do you think that they've been affected by all that's happening around us? And therefore will not be or will be in future?
It's difficult to give a generic answer to that because you have to go sector by sector and within a sector and see. They have been affected by higher input prices or higher interest rates, etc. And all of that will work positively once the cycle turns in terms of rates coming down or commodity prices moderating, etc.
Okay, let me redefine the question. So the question is more to do with, let's say, the political uncertainty, the logjam in decision making and all of that, which clearly has affected a lot of companies. What about the universe that you're investing in?
So again, I think, these things are transient. I don't see any of this as having a long-term impact on market trajectory, returns, etc. So like I said, we're looking out ahead 5 years, 3 years, 5 years. In that time period, I think, these things will not affect company earnings growth momentum.
And you're saying that most of your companies that you look at will, if facing a problem, will be able to bounce back or find their way out of it by then?
We think so.
Okay. Anup?
The structure of the companies in India is that we don't produce too many commodities. We have very few commodity companies in our index. We are actually the case of converters of commodities. So I think that the biggest positive that I see over the next 2-3 years is that if we have a slowdown in China or other places, and if the commodity cycle peaks off and starts to come off, a lot of the companies which are part of the index, which are actually converters of commodities, so whether it is a two-wheeler company or a car company, in the end they convert metal into value add. Those are the companies that will have a huge jump because of that. And if you look at the history of India, I think so. One of the key factors, or one of the factors that does drive a lot of profitability is that we have these branded commodities as a part of our business. So soaps are in the end a type of branded commodity. So if you have a sharp fall in the price of palm oil, it does impact the margin as such of the soap manufacturer. Similarly, in that as we move, that as we see that most of the products we make today and use are actually fairly basic and the value add is very limited, it depends a lot on the commodity prices. So if you have a drop in commodity prices, you'll find that the margins will expand fairly fast. And I think over the next 2 years, that will be the biggest driver to me in terms of profitability for the Indian companies to change.
Is that a good thing or a bad thing?
I think it's a good thing because if you look at our index or that indices compare, and that you compare it to Brazil or Russia, we don't have 60-70% of our index in companies which are there in commodities. We have more companies which are actually users of commodities rather than those which actually produce commodities.
Point before I throw it open, you talked about the changing character of the Nifty or the Sensex for that matter. You said, I think almost 11 of 30 companies are really more invested globally rather than India. So then what is the kind of call that you are taking as a fund manager? Or should investors who invest in your fund take? Because you're really now more a global or a quasi-global fund, even if you are an Indian fund.
So should you want a long answer or short answer?
Short, because we have...
No, I think so. I think we've changed over the years. In 1983, we actually won the World Cup in cricket, and we didn't know who the coach was, and we didn't have a physiotherapist, we didn't have a batting coach, we didn't have a video analyzer. And the game was played the same way. You have the same cricket played, you have a 22-yard pitch, and you hit a 4 and 6, and you win the match. But today, when we won the World Cup in 2012, we had a 12-member team which had 2 video analysts, which had 1 physiotherapist, which had a batting coach, which had actually a motivational coach, which had an overall coach. Similarly, fund houses have to develop as such. So 10 years back, they could have 3 studs managing 15,000 crores, and they had all the wisdom. Today, you need to have larger teams who are more focused in specialized area. You have to be more aware of what's happening around the world, and we have to invest more, unfortunately, on part of the business which most of the mutual funds don't, which is to build large competencies in trying to understand global trends and having teams which have the resources to go and meet companies globally and spend less on sales and spend more on the investment team. So if we do that, then we'll be able to cope with that. Otherwise, we'll just go with the trend. So we'll go up in one wave and we'll come down in the next, and we won't know what's really hit us.
A quick one on this. So when I'm investing in your fund today, or anyone is investing in your fund, what is he or she buying into? I mean, how much of it is really an India story and how much of it isn't?
See, I think it's largely an India story, and you don't have to, whether Infosys is an Indian company or not, they are selling in US, but why are they growing faster than the IT market? Because your cost base is in India, your competitiveness emanates out of India. So I would strongly feel that it is not just about local economic growth, but it is also about how competitive you are in services or in manufacturing. And IT spending globally has grown at 10% CAGR last 10 years. But IT services out of India have grown by 30% CAGR. Why is that possible? Because you are gaining share. And I think next 10 years, we will see a similar growth in manufactured exports out of India. If you look at the Indian currency against yuan, it is depreciated by 50%. Wage inflation in China is higher than in India. So Indian companies are becoming more competitive even in the manufactured exports.
You're applying similar metrics to assess, let's say, a Tata which becomes a Tata JLR as you would to an Infosys. Is that what you're saying?
No, what I'm saying is that, your local economy continues to grow, and Indian exports could grow much faster in the next 10 years as well. Now, if that happens, it's an Indian company, it's growing faster than the world export market because you are able to gain share. Why? Because you are more competitive. So I think it is still an Indian fund. Infosys is an Indian company. If you put Infosys in US, they would not have grown even at 20% of what they have done in last 10 years. So I think that point we need to, other than I think Telco and other than Hindalco, I don't think there are many businesses who are generating profits out of India. If you say Infosys is a US based company because they are selling in US, it's a different argument. But I don't think that's the right way to look at this.
Okay, all this is because we are trying to see what's things going to be 5 years from now. Okay, any questions for our panel here? Yes, at the... can you stand up and they'll know where you are here? Yeah, go ahead.
So the GDP numbers and IIP numbers what we are getting and all estimates suggest that it is trending down. Real investments in the country is also coming down. So there is no capital formation that is happening. All the corporates have put their investments on hold and no new investment is happening. So no new employment is coming up. And wage is also going up rather than coming down. So in this scenario, do you see that earning growth in next 1 to 2 years, which is subdued at this point of time, would take up? And if yes, then
let me collect a few more questions and then we'll come back. Anyone else? Okay, Nagnath, you want to respond to that? Capital formation and its pace or not?
It's a fact that capital formation has been very stagnant since the crisis of 2008, and had it been reasonably upbeat, I think we would have easily added 1 to 1.5 percentage points to our GDP growth. We still think that that process will start. I think a lot of initiatives taken in recent months and weeks do suggest that the pace of capital spending will pick up in the next 12-24 months. And once that happens, obviously, GDP growth will accelerate to that extent, employment growth will increase, income growth, et cetera, all the beneficial impact will follow. If for some reason it did not happen also, you will have capacity constraints building up, and certain companies in certain sectors, will have the benefit of operating at near full capacity, and if they have pricing power. So it's not as if earnings growth will completely keep declining if no capex spending does happen. Some areas will benefit from an uplift in margins, etc. But that's not the likely scenario. We still think capex spending cycle is set to move up quite significantly in the next 1 to 2 years. And again, over a 3-5 year period, we see that happening quite nicely.
Okay. Prashant, you want to respond to that?
There are 2 ways to look at this. One is what you and I know, what you and I are reading, the market also knows that. And so to an investor, he or she should not just focus on the news flow, because markets are forward looking and they tend to discount, be over pessimistic or over optimistic at times. So I think for investing, focus on the PE multiples. That's point number one. I think economic growth, yes, it is not that capital spending is not happening. It is just that it is not growing, right? So 1/3 of the GDP is still roughly in capital spending. It is just not growing. So that's point number 2. Third point is, I think why it should grow going forward. It may take 3, 6, 9 months, because 2 reasons why capital spending has been impacted. One is interest rates. That I think should get fixed over next 1 year as interest rates move lower. The second there has been a lot of challenges with regard to land, water, environment, forest clearance, allocation of mines. I think the government realizes this. They are putting together, that is what press reports suggest, a national investment board, and which is likely, if newspaper reports are to be believed, that will be a body which will be extremely powerful, and that will facilitate very fast clearances to the key projects. And I think over the next week, 10 days, we will know whether that is functional or not. But if that were to happen, I think clearly investment, it would help faster investment.
Okay. Any other questions? Yes.
See, in 2014, if BJP or Congress doesn't get in the power, and a person like Mulayam Singh or Lalu Prasad Yadav becoming a prime minister, what will be the scenario in the world about the Indian market?
So, who do you want to answer that question?
Anybody.
Anybody, okay. Yes, Prashant.
See, if you look at last 40 years, we have had different governments. Last 20 years, we have had only coalition governments. We will not be able to even name the prime ministers that we have had in the last 20 years. But even in those times, PEs never went below 10, 11, 12 times. Why don't PEs go below 12 times? Simply because at 12 PE, your current earnings yield becomes higher than your bond yields. And I think this country is growing rapidly, not just because of government, but it is growing for very fundamental, very basic reasons. Your population continues to increase, your family sizes continue to shrink, so number of families is growing faster than population. Your affordability continues to increase. Your literacy levels, infrastructure continue. We may complain about infrastructure, but it is rapidly improving. Look at mobile tariffs, look at mobile telephone, look at airports. So I think just because you bring in a different prime minister, I don't think you can say that this country will stop growing. Instead of 7%, it may grow at 6%. But 6% growth still means 12, 13, 14% profit growth. And a 10p, even for that kind of growth, becomes very cheap. And that's why in the last 20, 30 years, P's have never held below 10, 12 times. In September 01, which was probably a bigger crisis, when Lehman went bankrupt, 2008, global panic in equities, P's still don't go below 10, 12 times. Yes.
Okay, I think the last question that I'm going to ask all our three speakers, let me begin with you, Anup. So I think we've seen an interesting landscape, and it serves as a foundation to go into our next discussion, where we're going to talk about choosing the right asset classes and strategies for returns. All of you, I mean, everyone here knows, their investors, I mean, or your investors know that you have the skills to manage the funds, right? You have the skills and the experience. But tell us, what's the one new thing that you're going to do, or you're doing, to make returns more exciting, or discover new sectors or companies in the coming 3 or 5 years?
I think so. The best fund managers are the ones who do the boring things again and again with the discipline of doing it, ad nauseum. It's the ones who try to go and discover new things, which are the ones which get burned out fast. So I think so for us as an industry, and I'll just speak about our company, is that it's very important to build a second-tier team, to institutionalize some of the practices that we've brought in place over the last 5-6 years, and to be consistent in our communication with our investors, and have the conviction to stand for what we believe is right rather than be swayed. So we don't want to change the character of our funds because there's a change of fund manager or because the market has changed. And I think so just doing the boring things which people don't really like to hear about.
The one new thing, or the new kind of company, or the new kind of entrepreneur that you're looking for?
I think all those are the same. I mean, you're always going to be looking at different opportunities, new advancements in technology, disruptive pricing, the usual stuff that, the various variables that come into play when you analyze an investment. What I think needs additional effort is the point that either Prashant or Anup, I forget who mentioned, I think you mentioned it, Anup. This whole significant shifts in investment, the investment community's approach to taking risk or not taking risk, I think that has become more volatile in the last 2 years or so. And that leads to more volatility in different asset classes. And so perhaps a little more analysis of the psychology of investor behavior in the next year or two, as we still get through the current QE, as economic growth slowly begins to pick up elsewhere in the world, will be of additional importance, I think, in addition to what one does in the natural course of investing equities.
Okay. Prashant?
Anything fundamentally different, but I think today, if you look at our team, it has a lot of gray hair. So we are balding or graying, whichever way. So I think in the next 10 years, we would aim to make lesser mistakes than what we have done in the last 10 years.
So there must be something that you think will emerge, right? I mean, if we had this discussion, let's say, in the late 90s, the technology sector was emerging, right? Maybe a little later than that, there was maybe media emerging, maybe for a short while, but it was. What's the kind? I mean, people want to know what are you looking out for, and what's under your microscope?
One, we have been never early investors into a sector. I mean, because it's partly your personality and partly also you are a mutual fund. You don't want to take too much risk. And so we were not the first entrants into IT also. But we are constantly monitoring, and we were invested after 2 years it had really started coming up. But as I think next 10 years, if at all, I mean, I think Indian exports, Indian manufacturing will be globally competitive. I think that is one theme one is clearly seeing. And companies which have historically not done well, let's say like textiles or castings or leather, which were competing with China, I think that set of manufacturing in India could become more competitive, and that will help us in many, many ways. Because our share of global exports is minuscule. China is so huge. If you can do what you have done in manufacturing, even 1/10 of what you have done in services, it means faster economic growth, it means more employment, it means better profit growth. And I think that is one sector, I think, it's not one sector, but it is an area of economic activity, but I think manufacturing in India could improve dramatically in next year.